Good afternoon, everyone, and welcome to today's Facebook Live session. I hope that your studies are treating you well and that you are taking full advantage of the brilliant weather that we are currently experiencing. This is the very first session that we will be taking a look at IFRS 9, and once again, we will be looking at it through a question. Today, we will be looking at financial instruments through question 2 in your Financial Instruments for Accounting Beginners textbook. Once again, the first thing that we do when we approach any question is to first read the required. The required of this question states that we need to prepare the accounts for the investment in ordinary shares and the investment in rights to ordinary shares of Anati Limited in the General Ledger of Loyiso Limited for the year ended 31 December 2009. Note, round all final amounts calculated to the nearest rand. Now, they've asked us for accounts in the general ledger. They haven't told us that dates are not required or that you do not have to balance, and for that reason, we therefore have to provide dates and we have to balance our general ledger accounts correctly. Loyiso Limited entered into the following share transactions in Anati Limited, a company listed on the JSE Limited, during the reporting period ended 31 December 2009. On the 1st of January, the company had a balance of 2,000 ordinary shares at R2.25 each, which was the closing price on the JSE Limited on the 31st of December 2008. On the 7th of January, we purchased 2,000 ordinary shares for cash at the fair value of R2 each. On the 15th of January, we sold 400 ordinary shares for cash at the net fair value received of R2.05 each. On the 14th of February, Anati Limited had a capitalisation issue of 1 ordinary share for every 4 ordinary shares held on the 1st of February 2009. The fair value per ordinary share immediately prior to the capitalisation issue was R2.12 each. On the 26th of February, we sold 250 ordinary shares for cash at the net fair value received of R1.45 each. On the 6th of March, Anati Limited had a rights issue of 1 right to 1 ordinary share at R1.20 per share for every 5 ordinary shares held on the 1st of March 2009. The closing price per ordinary share on the 5th of March 2009 was R1.68. The rights are valid until the 1st of December 2009. On the 20th of June, we sold 400 rights to ordinary shares for cash at the net fair value received of 40 cents each. On the 2nd of August, we purchased 300 rights to ordinary shares for cash at the fair value of 55 cents each. On the 22nd of November, we exercised 500 rights to ordinary shares. The entity chose to do a fair value on the rights immediately prior to the rights being exercised. The fair value of the rights on the 21st of November was 48 cents each. And on the 30th of November, we sold 100 rights to ordinary shares for cash at the net fair value received of 42 cents each, and we sold 1,000 ordinary shares for cash at the net fair value received of R1.70 each. Additional information. Rights are not acquired for hedging purposes. On the 31st of December 2009, the closing price on the JSE Limited for an ordinary share of Anati Limited was R1.80. Brokerage has already been included in the price paid and has been deducted from the net selling price received. The brokerage per share per purchase or sale transaction is 5 cents. Now, when we look at financial instruments, it is important that you know when a financial instrument must be classified at amortized cost or when it is one of the 3 categories recognized at fair value. In this question, the investment does not meet the criteria to be held at amortized cost. Additionally, this is not a debt instrument and therefore it cannot be classified and subsequently recognized as a debt instrument at fair value through OCI. To be classified as an equity instrument at fair value through OCI, the entity needs to elect to classify an instrument into this category, and there was no information in the question stating that this is the case, and as a result, this investment will be classified as at fair value through profit or loss. Firstly, Now that you have classified the instrument, you need to remind yourself of when you will need to fair value adjust the investment. And the answer to that is that a fair value adjustment will need to take place immediately before the sale of any shares, when there is a rights issue, and at the end of the financial year. Importantly, when we have an investment at fair value through profit or loss, the transaction costs must be expensed, and as a result, they are not capitalized to the cost of the shares. The implications of this will be seen in the slides that follow when we actually go through the calculations and the general ledgers. The first few transactions relate to the investment in shares, so that is our starting point. When you look at the general ledger on the screen and in your textbook, you will see that we have many columns. It is always advised that you have a column for the number of shares in the investment, the price that the shares were purchased for, and then the rand total. By doing this, it is just easier to keep track of the number of shares that you have in your investment, which makes your calculations of fair value adjustments, capitalisation issues, and rights issues just a little bit easier as you have a running total of the number of shares. We know that on the 1st of January, we have 2,000 ordinary shares in Anati Limited. At the end of the 2008 financial year, the closing price on the JSE was R2.25 per share. At the end of the 2008 financial year, the shares would have been fair value adjusted to this amount, and as a result, these shares will be sitting in the books of Loyiso Limited at R2.25 each at the beginning of the current financial year. On the 7th of January, Loyiso Limited purchased an additional 2,000 ordinary shares at a fair value of R2 each. That R2 per share includes the brokerage cost of 5 cents per share. As the buyer of these shares, you are liable for the cost of the share as well as the brokerage involved in the transaction. The brokerage, however, must be expensed as this is an investment classified as at fair value through profit or loss. The 5 cents therefore needs to be deducted from the R2 in order to get the pure cost of the ordinary share to only be R1.95. Therefore, when we account for this transaction in the ledger account, we debit the investment in shares account with the total of R3,900, which represents the purchase of 2,000 ordinary shares at R1.95 each. Now, just to give you a better indication of why we deduct the 5 cents from that R2, the reason being is when you purchase a share, you are going to pay R1.95, and you are also going to pay the brokerage of 5 cents. So that 5 cents just increases the total amount that you pay in order to get your hands on this share. So in order to get the pure cost of a share, you therefore have to deduct it from the R2 in order to get the pure cost of an ordinary share. On the 15th of January, we sold 400 ordinary shares in Anati Limited, and we received a net fair value of R2.05 per share. That R2.05 is after the brokerage cost of 5 cents per share have been deducted. And in order to get the gross selling price of a share, we therefore have to add back the 5 cents brokerage fee. Now, when we sell shares, we receive an amount, but then we also pay an amount for brokerage costs. So we receive R2.10, but then we pay 5 cents, which means that the net value that we actually receive is R2.05. And that is why, in order to get the pure cost or the pure selling price of a share, we have to add back the 5 cents brokerage. Now, on the previous slide, I mentioned that we fair value adjust our investment just before a sale of shares. And when we fair value adjust, we adjust to the price received upon the sale of these shares. That means that all of the shares should have been fair value adjusted to R2.10 each before we accounted for the sale. If you take the 4,000 shares that we had in our investment before the sale of the 400 shares, and you multiply it by R2.10 per share, you get a total rand value of 8,400 rand. And that is what the total rand value of all the shares currently is, because the 4,500 rand plus the 3,900 rand equal 8,400 rand. So the shares are sitting at 8,400 rand each. For that reason, there is no fair value adjustment that needs to be recognized and recorded in the books of Loyiso Limited relating to the sale of shares. So importantly, you do need to perform a calculation just that you can be sure that, all right, there is no fair value adjustment. However, the fact that there is no fair value adjustment relating to this sale does not mean that that will be the same case going forward. So it's very important that you always check. On the 14th of February, Anati Limited had a capitalisation issue of 1 ordinary share for every 4 ordinary shares held on the 1st of February. We are told that the fair value of an ordinary share just before the capitalisation issue was R2.12 per share. Now, what is a capitalisation issue? In simple terms, the company increases the number of shares in issue but does not receive any consideration for these shares. It is a gesture by the company whereby each shareholder receives additional shares without having to pay anything. This is absolutely great for the shareholder, as at the end of the day, the shareholder receives more dividends as they have more shares in the company. When we have a capitalisation issue, we always account for the capitalisation issue by taking the number of additional shares we now have and multiplying it by the fair value prior to the capitalisation issue, as this is what our investment is worth due to the increased number of shares that we have acquired. As at the 1st of February 2009, Loyiso Limited had 3,600 ordinary shares in Anati Limited. 1 share was issued for every 4 ordinary shares held, and as a result, we received an additional 900 shares. These 900 shares are then multiplied by the fair value of R2.12 per share in order to get the gain on capitalisation issue of R1,908. Importantly, your contra account cannot be bank as we did not pay anything in order to receive these additional shares. On the 26th of February, we sold 250 ordinary shares for cash and we received R1.45 per share. Once again, we know that upon the sale of shares, we need to fair value adjust our entire investment. On the 26th of February, we had a total of 4,500 shares in Anati Limited, being the 3,600 balance brought down, plus the 900 shares we received due to the capitalisation issue. And these shares had a fair value of R1.50 on date of sale. It's the R1.45 plus the 5-cent brokerage fee. This means that the total value of our investment should be R6,750. However, if we work out what our investment is currently sitting at, it is more than the R6,750, and as a result, we recognize a fair value loss of R2,718. Therefore, in order to account for this, we debit fair value adjustment in the Splockie and we credit the investment in shares with this amount of R2,718. Now that we have done the fair value adjustment, we can recognize and record the sales transaction. Once again, the R1.45 per share is after the brokerage cost of 5 cents per share. Therefore, in order to get the gross selling price and the gross fair value of a share, we need to add back the 5 cents brokerage fee, which is how we then get to a Rand value of R1.50, which was also used above in order to get the fair value adjustment. Therefore, at the end of February, our investment consists of 4,250 shares with a fair value of R1.50 each. On the 6th of March, Anati Limited had a rights issue of 1 right to 1 ordinary share at R1.20 per share for every 5 ordinary shares held on the 1st of March 2009. Now that is quite a mouthful. What that means is you get 1 right for every 5 ordinary shares that you already hold in Anati Limited, and 1 right can eventually be converted into 1 share. The closing price per ordinary share before the rights issue was R1.68, and the rights are valid until the 1st of December 2009. As we have a rights issue, we know that we need to adjust our investment in ordinary shares to fair value. In order to calculate the fair value adjustment, we compare the value of the investment that has been carried forward to the fair value on the 5th of March 2009. The fair value on the 5th of March amounts to R7,140, which is calculated as the number of shares, being 4,250 shares, multiplied by the fair value per share of R1.68. The investment was sitting in the books at R6,375, and therefore we record and recognize a R765 fair value gain by debiting the investment in ordinary shares. Now remember, this financial instrument is a financial asset at fair value through profit or loss, which means that the contra account to this journal entry would be fair value through profit or loss. Now that the investment is sitting in the books at fair value, we can deal with the rights issue. Now the value of the rights can be calculated as follows, and for me this is the easiest method of performing the calculation. However, there are alternatives. We know that on the 6th of March, we already have 4,250 shares in Onati Limited, and those shares are trading at R1.68 each. That means that the value of the investment is R7,140. Based on the rights issue, we could have another 850 shares in the company if we convert all of the rights awarded to us. But how did we get that 850 shares? Well, one right was issued for every 5 shares. Therefore, 4,250 shares divided by 5 gives you 850 rights, and one right can be converted to 1 share. When and if we convert the rights to shares, we will have to pay R1.20 in order to get this share. Therefore, the value of those shares would amount to R1,020. The total value of the investment, if we did convert all of our rights to shares, would be R8,160, and we would have 5,100 shares in issue, which would then result in a value of R1.60 per share. By comparing the R1.60 and the R1.20, we can get the value of the right. The value of the right is the difference between the two, and in order to get the total value of the rights that we now have, we have to multiply that value by the number of rights which we are entitled to, which we have, which is 850 rights. The R1.60 represents the X rights price per share, and we want the investment in ordinary shares to represent the true X rights value. The value of the rights must therefore be taken out of the investment in ordinary shares and put into a separate general ledger account called investment in rights in ordinary shares. This general ledger account will be dealt with on the next slide. On the 6th of March, when the rights issue took place, we debited the investment in ordinary shares account with an amount of R340, and the contra account to that transaction was the investment in rights to ordinary shares in Onati Limited. Therefore, our investment in rights account has an amount of R340 sitting on the debit side. On the 20th of June, we sold 400 rights to ordinary shares for cash at the net fair value received of 40 cents per right. We know that we now need to fair value the investment in rights before accounting for this transaction. Once again, that net fair value received is after the brokerage fee of 5 cents has been deducted from the gross selling price or the gross fair value. In order to get the true selling price, we need to add back the brokerage fee, which then gives us an amount of 45 cents per right. We have 850 rights to ordinary shares, which we multiply by this new fair value price of 45 cents in order to give us the fair value of the rights to be R382.50. The rights are currently sitting in our books at R340, and therefore we recognize a fair value gain of R42.50. Now that the fair value adjustment has been taken into account, we can focus on the sale of the rights. We need to credit the investment in the rights account with this transaction, and the amount will be for R180, which is the 400 rights being sold multiplied by the fair value and the gross fair value of R1.45. On the 2nd of August, we purchased 300 rights at the fair value of 55 cents. This 55 cents includes the brokerage fee, which should be excluded and expensed. Therefore, the true fair value per right amounts to 50 cents. We purchased 300 rights at 50 cents each, and therefore we debit the investment in rights account with 150 rand. That now means on the 2nd of August, we have 750 rights to ordinary shares. On the 22nd of November, we exercised 500 rights to ordinary shares. If we exercise the rights, that means that we have converted the rights and have therefore received ordinary shares. The information stated that Logiso decided to fair value the rights immediately prior to the rights being exercised. Therefore, we first have to recognize and record a fair value adjustment. We know that we have 750 rights, and the fair value of the rights was 48 cents each, which means that the fair value of the investment in rights amounts to 360 Rand. However, the investment in rights is currently sitting in the books at 352 Rand and 50 cents, which means we need to recognize and record a fair value gain of 7 Rand 50 in relation to the rights. Therefore, we debit the investment in the rights and we credit the fair value adjustment. Now that we have fair value adjusted the investment, we can account for a portion of the rights being exercised. If the rights are exercised, that means that we have paid the additional 1 Rand 20 cents in order to get our hands on the ordinary shares. However, that 1 Rand and 20 cents is not the true value of the share, as we are paying a lesser amount in cash due to already having received a right months before, and that right comes at a cost. As a result, the fair value of the right on the date of exercise must be transferred to the investment in ordinary shares account in order to recognize the shares at a more reasonable fair value. We are exercising 500 rights, and the rights have a fair value of 48 cents each, and therefore we transfer 240 Rand to the investment in ordinary shares. On the 30th of November, we sold 100 rights to ordinary shares at a net fair value of 42 cents. Once again, this net fair value is after the brokerage cost of 5 cents has been deducted, and in order to get the true fair value, the 5 cents must be added back to give us a fair value of 47 cents. We know that before we recognize and record a sale, we need to fair value adjust the investment in shares. After exercising 500 rights, we only have 250 rights left, and those 250 rights have a fair value on the 30th of November of 47 cents. However, the rights are currently sitting in the books at 48 cents per right. We therefore have to recognize a fair value loss of 2 Rand and 50 cents, and therefore the investment in rights account must be credited. Now that the investment has been fair value adjusted, we can record the sales transaction by crediting the investment in rights with 47 Rand. That means that at the close of business on the 30th of November, we have 150 rights which need to be exercised before the 1st of December, or those 150 rights will be forfeited as the rights are only valid until the 1st of December. Now we can look at how that transaction with the rights affects the investment in ordinary shares account. On the 22nd of November, 500 rights were exercised, and therefore we had an additional 500 ordinary shares in Inati Limited. We paid 1 Rand 20 per share on exercise date, and therefore we debit the investment in ordinary shares account with 600 Rand. However, we know that we received these shares at such a reduced price due to the fact that they stem from a rights issue, and we know that each right has a fair value attached to it, and on the date of exercise, this fair value amounted to 48 cents. We therefore debit the investment in shares account with this amount as well in order to recognize the new shares at a reasonable value. On the 30th of November, we sold 1,000 ordinary shares at the net fair value received of 1 Rand and 70 cents. Once again, this net fair value received is after the brokerage cost of 5 cents has been deducted, and therefore in order to get the true fair value, we need to add back the brokerage cost. That then gives us a true fair value of 1 Rand and 75 cents per share. Due to the exercising of rights, on the 30th of November, we have 4,750 ordinary shares which need to be fair value adjusted. The fair value of 1 Rand and 75 cents per share therefore gives us a total fair value of 8,312 Rand and 50 cents. However, that is not what the shares are currently sitting at in the books. If you do the math, you would see that a fair value gain of 672 Rand and 50 cents must be recognized in order to get these 4,750 shares to fair value. Now that the ordinary shares have been fair value adjusted, we can recognize and record the sale of the 1,000 shares at 1 Rand 75 cents per share. After this transaction has been taken into account, we now have 3,750 ordinary shares in Inati Limited. The next date that needs to be dealt with is the 1st of December, the date that the rights expire. We are now working back in the investment in rights to ordinary shares in a Nati Limited account. We know that on the 1st of December, we still have 150 rights sitting in the books at a fair value of 47 cents. If these rights are not exercised, the rights are forfeited, and therefore a loss on the expiry of rights must be recognised. If we have no valid rights, we simply cannot have an amount sitting in the investment in rights to ordinary shares account. Therefore, the 70 Rand and 50 cents remaining in the account must be transferred to the loss on expiry of rights account, which will be disclosed in the SPLOCkie. Therefore, at the end of 2009, the investment in rights to ordinary shares has a zero balance. Now we are finally at the end of the question, and there is one last thing that we need to take into account. On the 31st of December 2009, the closing price on the JSE Limited for an ordinary share of Nati Limited was R1.80. So we are now working back in the investment in ordinary shares account. We know that at the beginning of December, the balance of the ordinary shares account was 6,562 Rand and 50 cents, which consisted of 3,750 shares at the fair value of R1.75. Now we know on the 31st of December, the shares are now trading at R1.80, which therefore represents the new fair value, and therefore we have to record a fair value adjustment because it is year end. So we know that we have 3,750 shares, we multiply that by the R1.80, and that gives us that our investment is worth 6,750 Rand. But the investment is currently sitting in our books at 6,562 Rand and 50 cents, which means that we need to recognize a fair value adjustment, again, of 187 Rand and 50 cents. Therefore, we debit the investment in ordinary shares and we would credit the fair value adjustment, which ends up in the SPLOCkie. That means at the end of the financial year, the balance that we carry down to the new year is 6,750 Rand. That then brings us to the end of today's Facebook Live. Once again, if you have any questions, please do not hesitate to contact us on FRK201 consult@gmail.com, or you can pop a message onto the Facebook group. I would also just like to encourage you guys, if you are struggling with a topic and that topic is going to appear in Year Test 3, please do not wait until the day before Year Test 3 to ask all your questions and to reach out for help. We are here for you. Email us, ask for consultation, email us your questions. We really are here to help you, and we want to help you achieve what you want to achieve and to all be successful at the end of the day. So on that note, good luck for all of your upcoming tests, and we hope to see you all soon on campus. And yeah, have a lovely afternoon. Bye for now.